Hello everyone, this is Phil Yaeger and welcome to Yaeger CPA Review, a video. Now, we couldn't do this live because of technical problems today, so I wanted you to see this in a video. And by the way, you have any questions, I will give you my phone number where you can reach me to discuss this area of non-monetary exchanges. Now, the way I'm going to do this is, I'm going to show you, I think it's 4 different scenarios, all right, with the different possibilities of what they would test you on for non-monetary exchanges. Now, a few definitions here. All right, if a non-monetary change has what we call commercial substance, what does that mean? That means it's going to increase future cash flows of the business. Now, if it lacks commercial substance, then it's not going to increase, all right, the cash flows in the future. So our first scenario will be this, all right? This transaction will have commercial substance and when a transaction has commercial substance, all right, if there's any gain or loss on the transaction, the gain or loss is recognized in full. Now, how do you calculate the gain? Well, let's take the information here. All right, I'm going to give you the information. The asset that we are giving up is made up of the following. All right, it has historical cost, and the historical cost of the asset we're giving up is $72,000. It has accumulated depreciation of $26,000, and also, all right, the fair value of the asset given up is $55,000. All right, now, first thing you have to remember is there any cash given or paid? Well, in this situation, all right, there is boot paid. And the boot is in the form of cash. So we're going to pay, to get the asset we're exchanging, we're going to pay boot paid. And the boot paid we're paying in this example is $13,000. Now, the first thing we want to do is to recognize the gain. Now, how do we recognize a gain on a like-kind exchange? Well, let's just get the gain. We take the fair market value of the asset given up, and we compare it to the book value of the asset given up. All right, now let's see what we have here. First of all, the fair market value of the asset given up is $55,000. Now, the book value of the asset given up is the following. All right, asset given up, book value is cost, $72,000, minus accumulated depreciation of $26,000. All right, that will give you a book value of $46,000. So, if the fair market value of the asset given up is greater than the book value of the asset given up, we have a gain. And the gain is $9,000. Now, when a transaction has commercial substance, I told you, after you calculate the gain, all the gain will be recognized. If the book value of the asset given up was greater than the fair market value of the asset given up, you would have a loss, and you recognize all the loss in full. So remember, when you have commercial substance, all right, if there's any gain or loss, it's all recognized in full. All right, now, the next thing is, all right, what about the journal entry here? All right, let's get the journal entry. All right, and I'm going to write this. All right, first of all right, we received, now let's get one more thing here. All right, the fair market value of the asset we received, all right, well, we don't need that. Okay, we don't need that. So anyway, all right, let's get the journal entry here. First of all right, we gave up accumulated depreciation of $26,000. So we're going to debit accumulated depreciation of $26,000. All right, that's coming up. Now, we'll credit the asset given up. All right, the asset given up, we're going to credit, and that is, looking here, $72,000 is the cost. So we'll credit asset given up, $72,000. Now, the next thing we're going to do is, all right, we're going to record the gain. Now, because all the gain is recognized, we'll credit gain for $9,000. All right. Now, remember, this $26,000 is a debit. It should be a little over here. All right. We have two credits, the asset given up and the gain. And also, remember, in this case, we're paying boot. So we credit cash of $13,000. All right. So these are our three credits. All right, this is our debit. Actually, I need that space above. Let me just clean this off here. All right, so, all right, we're going to actually have this. We have debits of $26,000. We have credits of $72,000, $9,000, and $13,000. Now, if you take your total credits and you subtract your debit, how much do you need to make this entry equal? And the answer is, all right, we need $68,000. And by the way, the number that we plug is always the value of the new asset. All right, so the new asset is the plug, and it equals $68,000. All right, so here we have commercial substance, gain or loss recognized in full. All right, to calculate the gain or loss, you compare the fair market value of the asset given up to the book value of the asset given up. All right, because it has commercial substance, all gain, all loss is recognized. Then, all right, what you do is, all right, you actually prepare the entry. You're giving up this accumulated depreciation, debit that. You're giving up the asset of $72,000, all right, and you're going to credit the gain of $9,000. You're paying cash, so you credit cash $13,000, and then, all right, we compare our debits to our credits, and we need a debit to make an entry balance. Whatever we need to make the entry balance is the plug figure, which is the value of the new asset. Okay? All right, now, let's look at the second scenario here, okay? Give you a second to look at this. Copy your numbers. All right, and hopefully you understand it. Now I will erase. All right, now the second scenario says this. All right, this transaction lacks commercial substance. That means it doesn't increase the cash flow. All right, and boot is paid. All right, boot is paid. Now, let's look at boot is paid. Now, this is the rule. First of all, calculate the gain on the transaction. All right, now let's get the figures here before we do that. All right, our historical cost is going to be $72,000, like before. Our accumulated depreciation will be $26,000. Now, the fair market value of the asset given up is $55,000. And now we're paying cash boot of $13,000, just as we did before. Now, the next thing we're going to do is calculate the gain. All right, now what's the gain? It's going to be the same as before. We take the fair market value of the asset given up, which is what? $55,000. We subtract from that the book value of the asset given up, which is what? $72,000 cost minus accumulated depreciation is $46,000. All right, so now we have a gain of $9,000. Now this is the rule. All right, when you have a transaction that lacks commercial substance and you pay cash boot, all the gain is deferred. All the gain is deferred. All right, so what happens is this. Now we'll record the transaction. All the gain is deferred. All right, so we debit the accumulated depreciation, the $26,000. We credit the asset, 72. We credit the cash, 9. And now, all right, none of the gain is recognized. When you have a transaction that lacks commercial substance and boot is paid, none of the gain is recognized. But if there's a loss, loss is always recognized. All right, so in our transaction, we'll debit accumulated depreciation 26, credit the asset given up 72, credit the cash. Let's do that. All right, now we'll credit cash for $13,000. And now we'll make our entry balance. All right, we have credits of 85, debits of accumulated depreciation of 26. All right, what do we need to make the entry balance? We need a plug, and the plug is $59,000. All right, $59,000. So notice what happened. All right, you just have to know how to make the entry. Remember, the new asset is always the plug. But where do you get the $59,000? Well, in the transaction which had commercial substance, where we recognize gain, all right, what happened? Well, we recognized gain, then all the gain was recognized. Now, in the transaction number 1, all right, if we go back to number 1, you'll see that the asset, the new asset, all right, was valued at $59,000. I'm sorry, not $59,000. Going back, the new asset was at $68,000. That was the first scenario. The new asset was debited for $68,000. Now, what happens is this: whatever deferred gain you have, because you paid boot and it lacked commercial substance, all the gain is deferred. So what are you really doing? You're taking the deferred gain and reducing the value of the asset. Now remember, all right, when we did not have a lack of commercial substance, all right, what happened was all the gain was recognized. Now when the gain is not recognized because it's deferred, notice what we did. In transaction 1, the new asset was $68,000. In the situation here, it's $59,000. So what we do is we subtract the deferred gain from the plug figure of the new asset. Do you see that? So don't worry about that. Just make the journal entry with the facts you know. All right, you always know the accumulated depreciation you're writing off. You know the asset you're writing off. You know if they paid any cash or received cash. And the plug is always what? The value of the new asset. Okay, that's all you have to know. All right, now let's go to the next scenario. All right, and the next scenario says you lack commercial substance and you have boot received. All right, so let's do this. We lack commercial substance and now we receive boot. Now, the boot received. All right, now let's see what we have here based on the facts. The facts are this. All right, now, the historical costs, we're going to change the numbers here. All right, the historical costs, let me just change the numbers here. I'm just going to erase this entry from the situation 2. All right, because we'll make another journal entry. But now we have boot or cash received. All right, now what's the facts? All right, with the asset given up, the historical cost is now $250,000. And the accumulated depreciation that was given up was $100,000. And the fair value of the asset given up was $200,000. And the cash we received from the transaction was $20,000. All right, now, here we go. All right, let's calculate the gain or loss. All right, we take the fair market value of the asset given up, and the numbers will be different now. All right, let's see what happens here. All right, with the asset given up, we take the fair market value of the asset given up to calculate the gain or loss. All right, and the fair market value of the asset given up is $200,000. Notice gain or loss is always calculated the same way, whether it lacks commercial substance or has commercial substance. Now we take the book value of the asset given up, which is the 250 minus the 100, which is 150. So the fair market value of the asset given up exceeds the book value of the asset given up. So there's a gain here of $50,000. Now, when you have a transaction that lacks commercial substance, all right, loss will be totally recognized if there was one, but to determine the gain that's recognized when you receive boot, you have to do a proration. All right, now this is the proration. All right, you take the numerator, which is the cash received. All right, now the cash received, all right, is how much? $20,000. Right. Now we divide that by the cash received plus the fair market value of the asset received. All right, let's get that. All right, first of all right, the fair market, I didn't give you the fair market value of the asset received, did I? All right, the fair market value of the asset received, I'm sorry, I just left that out. Fair market value of asset received is $180,000. All right, so here we go. Cash, 20, divided by cash of 20, plus the fair market value of the asset received, 20 plus 180 is $200,000. Now, whatever the cash is to your total transaction, all right, that's the proration of the gain that's recognized. So I multiply this by $50,000, the gain, all right, and this is what? 20 over 200 is 10%. 10% of the gain is recognized, and how much is that? $5,000. And the rest of the gain is deferred. Okay? Please remember that. The recognized gain is $5,000. Now, you only do this proration when it lacks commercial substance and they receive boot. All right? But notice, we calculate the gain, not recognize the gain, fair market value of asset given up, less book value of asset given up. That gives us the gain. To determine how much that gain is recognized, because it's what? Boot received. All right? You do a proration of the boot received to the total of the cash plus the fair market value of the asset received times the gain, and that's the recognized gain. That would be the recognized gain. All right, now let's make the journal entry for this. By the way, if boot is paid, all right, remember all the gain is what? Deferred. Remember that? All right, now this rule also applies if this happens. The boot received must be less than, all right, has to be less than 25%, okay? It has to be less than 25%, all right? The boot received has to be less than 25% of the total consideration received. All right, now, if that's the case, this is the rule. All right, now let's see here. The cash, all right, $20,000 over the total consideration is $200,000. The cash is 10% of the total consideration, 20 over 200. So therefore, this is the rule you would follow. Now, what happens if, all right, the gain was greater than 25%? Well, in that case, if it lacks commercial substance and the cash exceeds 25% of the total consideration, remember this. If the cash exceeds more than 25% of total consideration of the transaction, then all the gain is recognized. Okay? All the gain is recognized. If it's more than 25%. Here it's not, so you have to determine how much the gain is deferred based on this proration. All right? Now, let's look at the new journal entry. Here's the entry. First of all right, we'll debit cash. All right, we're going to debit cash. Is this showing here? Not really, is it? Is that showing? I'll have to move over the numbers a little. All right, we'll debit cash, $20,000. All right, now, we'll debit accumulated depreciation. of 100,000. We'll credit the old asset, 250,000. And, all right, we have here what? All right, we have a gain recognized of 5,000. We'll record gain recognized of 5,000. And now, whatever we need to plug this entry is our new asset. All right, so what do we have here? We have here $255,000 in credits, $120,000 in debits, all right? To make this entry balance, 255 minus 120 will give you a new asset balance of $135,000. Okay, there's the plug. All right, now, a few more things here. All right, what happens if the transaction lacks commercial substance, boot is received, and the boot is greater than 25% of the total consideration? Well, in this case, if it was greater than the total consideration, 25% the boot received, then all of the 50,000, all right, would be recognized. So now, if we looked at the same facts, all right, we would make the journal entry, debit cash 20, all right, we would debit accumulated depreciation, credit the old asset 250, all right, the gain recognized would be now, what? All $50,000. If it's greater than 25% and elects commercial substance, all the gain is recognized. And now we'd have what? 300,000 in credits, 120 in debits. All right, 120 in debits to give us a new asset balance of $180,000. All right, that's what it would be. Okay, all right. Does everyone see the journal entry? I think you do. All right, now, all right, one more thing is this. All right, when you have the test for, all right, the more than 25%, you take the boot received. Now, in this case, I'm just telling you it does. It doesn't really, because the boot received is what? 20,000. The total consideration received is what? The 200,000. It's only 10%. I just told you, assume that the cash is greater than 25%. All right, if you assume that, then you're going to recognize all the gain. The plug will now go up to 180,000. Okay? All right, so there are the various scenarios. What are they? First of all, if a transaction has commercial substance, all right, you actually recognize the entire gain or loss. How do you calculate the gain or loss? You compare the fair market value of the asset given up to the book value of the asset given up. If the fair value of the asset given up exceeds the book value, then you have a gain. Now, the next thing is this, all right? You make the journal entry, all right? And you're going to credit the gain on the journal entry. Now, what you're going to do is, all right, you're going to get rid of the cost of the asset surrendered, credit the asset surrendered, debit the accumulated depreciation of that asset surrendered. Now, see if there's any cash, all right, received or paid, all right? Just debit or credit that, and then the plug would be our new asset, okay? All right, now, if it lacks commercial substance, all right, and there's boot paid, all right, if it lacks commercial substance and boot is paid, then all the gain is what? Deferred. Remember that. If it lacks commercial substance and boot's paid, then all the gain is deferred. All right? Now, what happens if it lacks commercial substance and you receive boot, and the boot received is less than 25% of the total consideration? Well, in that case, you have to do a proration, which means you calculate the gain first. Take the fair market value of the asset given up in excess of the book value of the asset given up. All right? By the way, you don't prorate a loss. All the loss is recognized in full. You just prorate gain if you receive boot, and the boot in cash received is less than 25% of the total consideration. Now, in this case, if there is a gain, because the fair market value of the asset given up exceeds the book value of the asset given up, all right, to determine how much that gain is recognized, what do you do when you have lack commercial substance and you receive boot? which is less than 25%, all right, you do a proration. The numerator is the cash received. The denominator is the cash received plus the fair market value of the asset received times the gain you calculated. That's the amount of gain that will be recognized. All right, just put in the journal entry for the remaining items and you will debit what? The new asset for the plug figure. All right, now remember, if it lacks commercial substance and the cash received is greater than 25% of the total consideration received, remember, all right, if that's the case, then what's going to happen is, all right, all the gain will be recognized. All right, all the gain will be recognized. If it lacks commercial substance and the cash received exceeds 25% of the total consideration, then when you calculate the gain, which is the excess of the fair market value of the asset given up minus the book value of the asset given up, all right, all the gain is recognized when it lacks commercial substance, all right, and you receive boot, which is greater than 25% of the total consideration, all the gain is recognized. If there was a loss, all the loss is recognized. Loss is recognized in full in every situation because of conservatism. All right? Well, here's my phone number. If you don't understand this, and by the way, in the back of our book, we have several questions on this. All right? You can find them. But if you still have a question on this, please call me. My number, 301 area code. Let me put this up here for you. All right? 301-874-4900. And my extension is 5. All right? Extension 5. 301-874-4900, extension 5. All right? You can reach me 7 days a week. I'm on the East Coast. All right? So please remember, compare your time to where I am. All right? You call me at 10, 11, my time, that's fine. But when you start getting 12, 1, all right, unless it's an emergency, which I don't think accounting, CPA review is an emergency, at least not in my house, all right, then just wait until the next business day. All right? But the point is, you can still reach me if you didn't understand these scenarios, and if you didn't understand, and you know, I had a problem with some of the multiple choice I went over, all right, make sure that you know it. Now, let me just read to you. You say, why would they ask this? Well, this is why they ask. There's a separate blueprint for this area. And the blueprint says, calculate the amounts necessary to prepare the journal entries to record a non-monetary exchange. All right? I showed you how to get the journal entry in each of these situations. So we met the what? The requirements of the blueprint. So they expect you to know the different types of non-monetary considerations. All right? They want you to know when it lacks commercial substance, all right, and when it has commercial substance. But when it has commercial substance, all the gain or loss is what? Recognized. But when it lacks, you have to know the various things. Namely, if boot is paid, all the gain is deferred. All right? If boot is received, all right, as long as the boot received is less than 25% of the total consideration received, then you have to do the proration. The proration is the cash divided by the cash plus the fair market value of the property received times the gain you calculated, which is the excess of the fair market value of the asset given up minus the book value of the asset given up. Now, if the cash received, if lacks commercial substance, and the boot received is greater than 25% of the total consideration received, then all the gain that you calculated is recognized in the journal entry. That's it, ladies and gentlemen. Thank you very much. I hope I made this a little easier for you. It's not an easy subject, but because it's a separate blueprint, I think you should know it. Okay? Take care, and we'll see you soon. Thank you for watching.